Alrighty, so welcome to our monthly Money Life webinar. I'm Jim Allen. As usual, I'm here with Blake Pinion and Anchor Bay Capital. And so tonight we're going to talk about a new topic. And we've been talking about the Secure Act for the past couple years. And pretty much all last year we talked about Secure Act 2.0. Is it going to pass? Isn't it going to pass? Well, it finally has. It's become law. And so we thought we should have a webinar on it to talk about some of the features. We're just going to give you kind of the juicier parts of this act. There's a lot of things to it. Honestly, a lot of it pertains to people who are still, not in retirement, but they're still accumulating money in retirement plans, things like that. So there's a lot of features in Secure Act 2.0. So we're just going to cover kind of what we think are the big ticket items. And as always, this is being recorded, and so you'll be able to go back and view it on our website. Blake is also in the process of posting some informational articles about Secure Act 2.0 onto our website, so you can get more information there. So we're certainly happy to take any questions at the end of the presentation. You can just put those in the Q&A feature on the toolbar, and we'll answer any questions. We should have plenty of time for questions on the back end. So let's go ahead and dig into it. All right, so again, Secure Act is, if I remember right, Blake, it's like 125 pages. So there's a lot of stuff to it. But we're just going to kind of cover the big ticket items. And so the one that maybe you've probably heard the most about are changes to the required minimum distribution age. So, for years and years and years, you had to start taking money out of your retirement plans at age 70 and a half. Well, Secure Act 1.0 changed that to age 72, which is what we have now. Secure Act 2.0 has changed the required minimum distribution age again. So we're going to talk about what those are and who those will apply to. In addition, they've expanded catch-up provisions. So for those of you that are over 50, you're trying to sock a little bit extra money away in your retirement plan prior to retirement, they're going to allow you to put more money in. This provision's kind of a weird one, and we'll talk about the rules surrounding it. It's only for a very short period of time, but if you're in this age range that they're allowing, you've got pretty significant additional catch-up provisions. Then we're going to talk about some changes to Roth 401k opportunities. So there's some things there. Then we're going to talk about kind of the one gotcha in Secure Act 2.0. Virtually everything else is favorable for people planning for retirement. This catch-up 401k change is a gotcha, and it will impact some people. So I'm going to cover those 4 bullets. Then Blake's going to talk about some of the college planning opportunities that are in Secure 2.0. The ability to use some retirement plan money related to college planning. So let's go ahead and dig into the first one. The biggie is the change to required minimum distribution age, or RMD. So the way the rule is, like I said, prior to Secure Act 1.0, it was at 70 and a half. And so when you hit required minimum distribution age from your IRAs or your 401ks or 403bs or whatever type of retirement plans you have to start taking money out. And so Secure Act 1.0 changed that age from 70 and a half to 72. So for everybody that's already started required minimum distributions, you're taking them out at age 72. If you don't take the right amount out, they're going to hit you with a 50% penalty for the amount you should have taken out. That's also another change. They're changing the penalties. I believe it ultimately gets reduced down to a 10% penalty if you correct them. So there's some changes there too that we won't go into detail about. But going forward under Secure 2.0, if you were born between 1951 and 1959, now your RMD age has been increased by 1 year to 73. So you don't have to start taking any money out of your retirement plans until age 73. There is one exception to that. If you're 73 and you're still working, and you're an employee, you don't have to take money out of that employer's retirement plan. If you're a business owner, it doesn't apply to you, but if you're an employee and you're still working at say 75 or 80, you don't have to take money out of that particular retirement plan. If you have other IRAs and things, you'll still have to take RMDs out of those. So 51 to 59, now you can wait an extra year and you can start taking money out at 73. If you're born at 60 or later, then you still have some significant amount of time before you're going to hit RMD age. Your age has been increased to 75, and so you're going to have an additional 2 years before you have to take some money out. Now, does that mean you should automatically do that? Not necessarily, because they raised the age, but they didn't really change the tables, which means if you wait till age 75, your life expectancy is going to be shorter than it would have been at 72, and therefore you're going to have to take larger distributions. So right now, at age 72, you're forced to take out about 3.5% of whatever your balance is. So it's not a big number. Age 75, it's not going to be that much higher. And so we'll just have to, when we're doing our planning, we're going to have to figure out, okay, should we wait until the required minimum distribution age, or should we be taking money out sooner, just so that that IRA or 401k balance doesn't get so large that, we'll have really big forced distributions down the road. So this is the major change to, Secure Act 2.0. It's the one most people have heard about. These numbers aren't really significant. 1 year to 3 years, depending on the year you were born. It'll still help, probably in many cases, and it gives us a little bit more planning opportunity. But it's not a significant change.
Yeah, and one thing I was going to add to that is it increases the window for Roth conversions. So now we have more time with this change to convert money from the traditional IRA to the Roth. So what this ultimately means is we could try to lower your future tax bills. We have a longer time horizon in that sense.
Yeah, that's a great point, Blake. One of the things we want to do before you get to required minimum distribution age is to try and freeze or slow down the growth in your retirement plans. Because, if you've been socking all your money away in the IRA or the 401k, that's great. You're not paying any tax currently, but you're going to pay tax down the road, and you're going to be forced to take it out. And as we've talked about in several of our webinars, you won't necessarily be in a lower tax bracket in retirement. So we like the concept of kind of having different tax buckets to pull from and try and slow down the growth in the taxable IRA or 401k, so we don't have as large a distribution in the future. One of the main ways we do that are Roth conversions. And so, this will give it an extra year to 3 years to play the Roth conversion game. So the next one is change to the catch-up provisions. So IRAs and 401ks both have catch-up provisions. So if you're over age 50, you can put a little extra money away in your retirement plans. And for IRAs, correct me if I'm wrong, Blake, but it's still, I believe, $1,000. Well, actually, I think, didn't they change it to $1,500 now? It's $1,000. Yeah, it's $1,000. It's $1,000. And it wasn't indexed for inflation. So that's one of the changes. Now it will be indexed. They raised the regular IRA contribution limit by the $500. That's what was confusing me. But the catch-up has never been indexed. It's always been $1,000. Now they're going to index it for inflation. It'll only go up in increments of $100, so it won't necessarily go up every year. The current environment, it may go up more than $100. Now this one's not effective till next year, 2024. But starting in 2024, that $1,000 IRA catch-up contribution will be indexed, so it should, in theory, go up by $100 or more every year. The change to 401k catch-up contributions is even bigger. 401k catch-up contributions is, again, correct me if my numbers are wrong, Blake, but I believe it's $7,000. And so what they've done here is they've said, and I don't know how they came up with the dates, they said if you're between 60 and 63, starting in 2025, so you got to wait 2 more years, you'll be able to as a catch-up, instead of 7,000, it will be 10,000 or 150% of the normal catch-up. So if the catch-up was 7,000 this year, 150% of that would have been 11,250. So you'll actually be able to sock a fair amount more away in your 401k. Again, it doesn't start till 2025, and it's only for the ages 60 through 63. So, you know, those of you that are like age 60 now, you're going to miss out on a couple of years of this because it's not going to become effective until 2025. So it's kind of an odd one, but again, more opportunities to sock money away in retirement plans that are available to us. So it gives us a little more planning flexibility. Next are Roth 401k changes. So, you know, if you're not familiar, we love Roth retirement plans because you pay tax on the money going in, but you never pay tax again. And in a Roth IRA, not only do you never pay tax when you take it out, assuming you're over 59 and a half and you've had it 5 years, but you also didn't have required distributions. The reason for that is with a regular IRA or a 401k, you're not paying tax when the money goes in, it grows tax deferred. So when you take it out, they're going to collect their tax. They're going to get paid at some point. And that's the other reason they force you to start taking out. It's like they don't want this to be just a tax deferral vehicle. It was intended for retirement savings. Well, with the Roth, they collected their tax up front. So they don't care about collecting tax again. So they don't have a required minimum distribution. One quirk, though, was if you have a Roth 401k at work, and you know, a lot of companies have now offered a Roth version of the 401k where you don't get to defer your salary. You're going to pay tax on the money going in the Roth 401k, but again, you don't pay tax in the future. However, they did have an RMD. For some reason, if you had a Roth 401k, you still had those required minimum distributions at 72. Well, effective next year, then Roth 401ks will look like a Roth IRA and you won't have an RMD on those. So again, if you accumulate a bunch of money in a Roth 401k, you don't have to take it out. And when you do take it out, it'll be income tax free. Or if you don't take it out and you pass away with it, your heirs will have to take money out, but it'll be income tax free to them too. So one of the main reasons we really like Roth, so you don't have RMDs and it's tax free. So next year, no RMDs for Roth 401ks. Starting this year, you can now have a Roth option for a SEP and a simple. So those are other types of employee benefit plans, retirement plans that are available for small business owners. Before, you could make contributions to a SEP or a simple, but you didn't have the Roth option. Now you do. That's effective immediately. Here's the problem with that is if you have one of these types of plans, you have plan documents, and you can't just automatically say, oh, now it's a Roth. You're going to have to amend your plan documents. And so it's going to take some time for the plan custodians and administrators that offer these types of plans to add Roth options to their documents. So yeah, it's effective immediately, but it's going to be some time before that really is going to be available to you. The other thing, and I think this is kind of the nice one, the big one, and it's effective immediately, is before you could have a Roth 401k option at work, but all company matches. So, you know, if your plan said they'll match dollar for dollar up to 4% of whatever you put in, that went into the regular 401k option. So you didn't pay tax on it, but you'll pay tax when it comes out. Now you can elect to have those company matches go to a Roth option. Again, it's effective immediately, but like the Roth option for SEPs and simples, you can't really do it until the plan is changed so that it allows to do that. But that one will be a nice one because you can make pre-tax deferrals to the regular 401k and say, I want my match to go into the Roth and vice versa. So it gives a little more flexibility and some more ability to stuff more money into the Roth option. So
yeah, there is a gotcha with that I wanted to mention though. So because it's going to the Roth bucket instead of the pre-tax, technically those Roth contributions that are going into the Roth 401k are included in the employee's gross income.
Correct.
So something you want to be aware of is they might lead to an unexpected tax bill when you file your return come April. You weren't planning to have that additional amount of taxable income. So something to be cautious of. Those are considered employee taxable income if they go into the Roth bucket.
Yeah, and Blake's absolutely right. So what you're doing is if you're changing a pre-tax match to a taxable match, again, that may make a ton of sense. And that's why we focus so heavily on the tax planning stuff, is to figure out what's the right mix between those two options to optimize your tax situation now and in the future. So I have one more, and then I'm going to turn it over to Blake. This is what we're calling the Rothification of catch-up contributions. And this is the one that's kind of a gotcha. So what this new law says, and it's effective next year. So, you know, these new rules that they have are all over the place. Some are now, some are next year, some are 2 years from now. So you kind of have to be aware of when these rules kick in. But starting next year, if you make more than $145,000 at that employer, so, you know, if you're working for XYZ and it's their 401k, if you make more than $145,000 at XYZ, your catch-up can only go to the Roth 401k. So Blake just talked about, you know, how if you're going to make a match to the Roth 401k, that now becomes taxable. This will be the same way. So if you're going to make that $11,000 catch-up contribution that we talked about a couple slides ago, if you make more than $145,000 at that employer, it has to go into the Roth 401k. So it's great. You can make these catch-up contributions, but they're not going to be tax deferred like they were before. And the other gotcha here is if you don't have a Roth option attached to your 401k, then you can't make a catch-up. So a lot of employers are going to have to amend their plans to allow for a Roth option so that the highly paid employees, if they want to make a catch-up, they can put it into the Roth option. So this is one of the revenue raisers in Secure Act. Like I said, most everything is a positive for people trying to save for retirement. This is a negative that you want to stuff that extra money in pre-tax. You're not going to be able to do it if you make too much money. So those are kind of the biggies in terms of retirement plans. I'm going to turn it over to Blake and let him talk about some kind of unique options that are going to be available that are kind of a combination of retirement and college planning. And then we'll go ahead and open up to questions afterwards. So go ahead, Blake.
Thanks, Jim. So one of the more popular provisions that came out of Secure Act 2.0, it's getting a lot of buzz and talk lately, is the ability now effective in 2024 to move money from a 529 plan to a Roth IRA. And a 529 plan is an education savings account, so you put money into it to be used later on for higher education expenses. We talked about a Roth IRA. So what you're now able to do in 2024 is move money from the 529 plan directly to the Roth IRA. However, there's a lot of strings attached to this. A lot of conditions must be met in order for this transfer to be valid. And the first thing that I want to note here is that we're talking about the 529 plan beneficiary and not the owner. So typically, a 529 plan owner is a parent or a grandparent, and the beneficiary is a child or a grandchild. So this is the benefit for them and not the parent or grandparent unless the beneficiary is changed, which I'll talk about later on. So that's the first thing to note. So how this works is you're able to move up to the maximum Roth IRA contribution limit each year from the 529 plan to the Roth. So for 2023, that's $6,500 if I'm under the age of 50. If I'm 50 or older, I get the additional $1,000 catch-up for $7,500. So if I'm under the age of 50, I can move $6,500 from my 529 plan to my Roth IRA and do that each year until I reach my lifetime maximum per beneficiary of $35,000. Another thing to note here is that the Roth must be the same person as the 529 plan beneficiary, right? So if I have a 529 plan set up for my daughter, Susie, I would need to set up a Roth IRA in Susie's name and do the transfer from Susie's 529 plan to Susie's Roth. But this is also treated as a contribution, meaning I can only do this transfer if Susie, my daughter, has earned income. Because the way that Roth IRAs work is you can put in the lesser of $6,500 if you're under the age of 50 or earned income. So if Susie doesn't have any wages, then I couldn't do this transfer. Or if Susie had wages of $4,000 in 2023, I could only move $4,000 to Susie's Roth. If she had 8,000 of wages, then I could do the maximum of 6,500. So it's considered a contribution. And then the next critical points of this is that the 529 plan must be active for at least 15 years before you can do this transfer. So we're talking about legacy 529 plans only. And the last 5 years of earnings or contributions are not eligible to be moved. So if I have a 529 plan for 15 years, then I can only source the funds of the transfer from years 1 through 10. So again, there's a lot of criteria that must be met in order to make this transfer valid. And now I'm going to go into the planning opportunity. So the planning opportunity that comes out of this, I guess the first thing I'll say is there's still some unknowns and questions that we have and questions that everyone has in terms of how the 15-year rule is going to be treated when beneficiaries are changed. So before this was passed, I can change the beneficiary on a 529 plan from Susie to her brother John, or even myself as the owner. You can change the 529 plan beneficiary. So the question with this is, if I change the 529 plan beneficiary to John, does that 15-year clock reset? So do we have to wait another 15 years before we can start moving money into little Johnny's Roth IRA? And that's the unknown at this point, and we're still getting guidance and clarification from the IRS and legislators. But if you don't have to reset the clock, if we don't have to wait another 15 years, what we think we're going to see is generational 529 plans to where they can be used as a mechanism to fund retirement instead of solely being used for college. And what I mean by that is I will just move the money into my beneficiary's 520 or Roth IRA each year until they reach their lifetime maximum of $35,000, and then change it to another family member and continue to do that process as long as I have money in my 529 plan. And another note with 529 plans are that there's no set time period to where the money has to leave it. Unlike other educational savings accounts, I don't have to empty out a 529 plan in a certain amount of years. So if I had a large 529 plan, again, I could keep putting $35,000 maximum transfer into a beneficiary's Roth and do that with another family member and continue that cycle indefinitely. And that's what the example explains here. So if I had a $50,000 529 plan, I can designate $25,000 to child A, and then once child A gets their fair share, I can change it to child B and put $25,000 in their 529 plan. So an ability to use 529 plans in a different way. And that's why I wrote an article on this topic, and you can find it on our blog, and I provide some more details. So I encourage you to check it out. And then the last thing that I'll touch upon is the new student loan matching provision that came out of Secure Act 2.0. So essentially what this says is that employers can now make matching contributions to an employee's 401k based on the amount they pay towards their student loans. And this is easier to understand through an example. So if I'm Johnny and I graduated from college with a mountain of student loan debt, and I started a new job that offered a 401k that I can contribute to, but I can't afford to contribute to my 401k and pay my student loans at the same time, I now can just put money towards my student loans, and my employer may treat those student loan payments as if I were contributing to my 401k and match that dollar for dollar or percentage for percentage. So I'm Johnny, I put $500 a month towards my student loans. My employer, depending on their matching provisions, could put that same amount into my 401k. So ultimately, what are we doing here? We're paying off our debt and saving for retirement at the same time. So it's a win-win scenario. And this takes effect 2024. So these student loan payments are treated as an employer salary deferral for matching purposes. But this is a win for employees, and it's definitely a win for employers as well, being able to attract and retain new incoming employee prospects. So a great provision that came out of Secure Act 2.0.
Yeah, and I would just add, this is another one of those things that before this can become effective, the employers are going to have to change their plans to allow for these kind of things. So it, you know, we have a year, so by then maybe the provisions will be built into employers' plans, but that would be kind of the hang up. This may sound great, but if your employer plan doesn't allow it, you won't be able to utilize it. So we just wanted to, again, briefly touch on some of the highlights because this was just hot off the press. You probably heard some things about it, so we wanted to at least give you kind of a brief overview. We will provide a lot more information in our blog postings on our website over the next few months as we get clarification, things like that. So before we turn over to questions, just a couple of housekeeping items. This is being recorded, so you can go back and watch it on our website, or if you know people that would like to see it, you know, refer them to our website. Also, because we're now in the throes of tax season, so we're in the middle of preparing our clients' tax returns and doing tax planning. We're going to be dark for the next 2 months. So we'll resume these webinars in May. And just also just as an FYI, in case you don't know, with all of the flooding we had in January here in California, California was declared a disaster area, a federal disaster area. So California residents have an extra month to file their tax returns this year. So you have until May 15th to technically file your both federal and California returns. So you have a little bit more time to do that if needed. So just as an FYI. So with that, we'll go ahead and open it up to any questions you may have. And you can just put them in the Q&A and we'll be happy to answer those. Or if you prefer, you can just reach out to Blake or myself and email us your questions or give us a call, and we're happy to answer them or discuss this in more detail with you.
Yeah, and while we're waiting a few minutes, so I mentioned the 529 plan to Roth IRA transfer article is on our blog, so be sure to check that out for more information. We're also going to write an article on all the Roth related changes, as there's a lot of meat on that bone, as you can see from the presentation today. So look out for that blog posting sometime later this month, and it'll be featured in our newsletter as well. So our goal is to put out a series of articles, as we mentioned, on the major provisions within Secure Act 2.0 to get you the information you need.
Last call for any questions. All righty, if not, well, we thank you guys for attending. As I mentioned, you can rewatch it on our website probably sometime next week, and we'll resume these in 2 months. And everybody have a great rest of the week. Talk to you soon. Bye.